Welcome. In the world of investing, a great debate has raged for decades. What's the best way to analyze a potential investment? On one side, you have the detectives, the fundamental analysts, who pore over company financials to determine a business's true worth. On the other, you have the chartists, the technical analysts, who study price movements and market sentiment to predict future direction. Many see these as opposing forces, but the truth is they're not mutually exclusive. They are two different languages, both attempting to tell the same story, where the market might be heading. Today, we're going to dive deep into both, not to pick a winner, but to understand their core philosophies and, most importantly, how you can use them to build a more robust investment strategy. Let's start with fundamental analysis, or FA. At its heart, FA operates on a simple, powerful premise. A stock is not just a ticker symbol, it's a fractional ownership of a real business. Therefore, to understand the stock's long-term potential, you must understand the business itself. Fundamental analysts act like business valuators. They dive into financial statements, the income statement, the balance sheet, the cash flow statement, to gauge a company's health and profitability. They ask questions like, is revenue growing? Is the company managing its debt well? Does it generate consistent cash? They look for a company's intrinsic value. A key concept here is the economic moat, a durable competitive advantage, like Apple's ecosystem or Coca-Cola's brand, that protects it from competitors. By comparing this calculated intrinsic value to the current stock price, they decide if a stock is overvalued, undervalued, or fairly priced. This is the bedrock for long-term, value-oriented investors. Now, let's pivot to technical analysis, or TA. If fundamental analysis is about a company's value, technical analysis is purely about its price. Technicians believe that all known information, all the earnings reports, news, and economic data, is already reflected in a stock's price. So instead of studying the business, they study the price chart itself. Think of it as financial archaeology. They look for patterns, trends, and signals in historical price and volume data to forecast future movements. The candlestick chart is their primary canvas. They identify key levels of support and resistance, which are zones where buying or selling pressure has historically been strong. They use indicators like moving averages to smooth out price action and identify trends, and oscillators like the Relative Strength Index, or RSI, to gauge if a stock is overbought or oversold. For a technical analyst, the why doesn't matter as much as the what and when. It's a